a, a little group discussion on what we would do here, and again, using the 1, 2, 3, the 3-step sales process, what we would do. Okay, so we got the email, and I'll edit a little bit, but it basically just says, I have someone that I've met with about life insurance, and they need to get back to me because it turns out they have some kind of policy, but they have no idea what it is. They think it may be a universal life policy, but not sure yet. So what would you do if you were meeting with someone and they had a policy, but they didn't, excuse me, they didn't know what kind of policy it was and what they needed to do?
Well, I'm going to jump in and just say that one of the reasons why I was concerned about telling him to do anything is because he doesn't personally have a copy of his life insurance policy or else know what he has, and therefore he has to contact his agent.
Well, let's go through that. You don't have to contact your agent to get a copy of the policy. Now, they will be notified by the insurance company when you call the insurance company directly and ask them to send a copy of the policy, then they will. Also, every insurance company, especially if it's a UL policy like you think this might be, they are required to send either electronically now or in the mail an annual statement. Okay? And so the annual statement, they might have that in their files. Or again, what I do is I just have them call the insurance company and have them get a copy. But they will notify the agent of record that they have called to ask about it. And you bring up a great point. I mean, we need to arm our people that we're meeting with for any type of objection or contact with their prior agent. Most of the time, unless something like that happens where you ask for a copy or you call up the company asking questions or things like that, a lot of times the insurance agent is fine to get their commissions, but they don't follow up a lot. So, and many times they don't follow up at all. And so, in a sense, you're rousing up the competition in a way. But there are a few things that you can say on the first appointment to kind of disarm that conversation or prepare your client for when that conversation comes. One of the things that you could say is, hey, we need to get more information to see exactly, where you're at. Obviously, the first step is for me to gather the information. I can't do analysis and research unless I know exactly what it is we're dealing with. So if they don't have an annual statement or a copy of their policy, you are, even if they never did any business with you, you are doing them a huge favor by educating. And I believe that what comes around goes around, and if you give out and help and serve, and you give to that person, that it's going to come back to you. Maybe not with them specifically, but maybe even down the road with someone else. So serving and giving is going to be the best thing. But then I would say, hey, look, when was the last time you heard from your agent? Oh, they could say something like, well, he's my brother. I see him, all the time. Or they could say, I haven't heard from him in 10 years. I had a client that I met with yesterday on an insurance policy. They got sold in 2001. It was a $10,000 universal life policy, just $10,000 face. And the policy lapsed, and their insurance agent didn't call them. And because the client got the notification from a different insurance company than what was on their policy, because as you know, these insurance companies get bought out and sold and merged from time to time, she just put it in the garbage, not thinking that it was anything she had. She thought it was a solicitation, and her policy lapsed. So I'm trying to help them get reinstated, because now the husband has cirrhosis of the liver and he's uninsurable. So, those type of things can happen, and it's better, I think, for us to serve those families. But arm them and say, if they haven't seen them for a while, just say, hey, look, I'd like to earn your business. Don't be sneaky about it. Be straightforward. Say, I'd like to earn your business, and I hope that we can do business together. Obviously, once we find out what this policy is, if it makes sense to switch it out, and financially it makes sense, and in other ways it makes sense and you understand it, then we would do that. But if it doesn't make sense, then we're not. You can also, I got an echo, I don't know why, but you can also become the agent of record. They can fill out what's called, if you guys, hopefully you guys are taking notes, you can fill out a change of agent form with the insurance company as long as you're appointed with that company, which, again, we're appointed with most of them. You can fill out that form, and then you can service that person's policy. You may not get paid on it, but you can even switch it out if they prefer to work with you. And so I say this as well. Here's something else you can write down. You know what? I don't want to step on any toes. But at the same time, I want to help you. I want to get to the bottom of this and be able to do some research. You think it would be stepping on toes if I were to help you order a copy of your policy and do some research on that? I think that's a fair question. And they're going to tell you, oh, yeah, this guy's been my best friend since high school. So, yeah, I don't really want to offend him. I'll just call him up and say, well, he may be a little offended that you're working with me on this to do it. And you say, and in other words, bring it up on the first appointment before you do all the legwork, before you make all the recommendations. You don't have much of a chance anyway of having them buy a life insurance policy through you if they're that close. Wouldn't you rather get a quick no on the first appointment? You still have them as a referral source. Down the road, there may be other products. There may be family members that need their help. It could be someone that you recruit to earn part-time income, to get a life insurance or other license. I would rather know on the first appointment instead of waiting. Does that make sense?
So, yeah, absolutely. So, John, with regard to life insurance, if I were to say, do you feel like I'm stepping on toes if I helped you order a copy of your policy so we can look further into, kind of do a review? How do I do that? Because I don't think a life insurance company would just tell me to get a copy of somebody's life insurance policy.
Well, the client would do it. And what I do whenever I'm getting information about a client's documents is I get on the phone right then and there and do a three-way call.
Okay.
To make sure it gets ordered, unless, they can do it themselves. But when I'm on the appointment, I like to do that. They see me in control. They see me as being the expert in the room. And if they don't have a copy of their annuity policy or their life insurance policy, or you want to even ask questions of the insurance company, like once you get the UL policy, and if there's all kinds of circumstances that could come up, but you would help them ask those questions. And all you do when you're on the three-way calls is you have them, start the call out, and all they do is simply say, I have my friend on the phone, Julie, and I would like her to also be able to listen in and ask questions if need be. And I give permission to do so. It's always a recorded line, and so they have to give permission if you do this over the phone. The federal government, the IRS, everything works exactly the same way. Doctor's office, everything. As long as they have your written or oral permission, then they can do it. Now, some companies may say, you need to give permission in writing for me to talk to this other person, even on the phone. But, that's a more rare situation, and it's usually related to HIPAA, medical release, and things like that. Okay, but for sure, to go on with your questions, you said it may be a universal life policy. Until we know for sure, we don't even want to talk to the person about switching it out. It's better if you, on the first appointment, are the one that's holding back the reins. Because remember what I said on the very first call that we had? Most people don't like life insurance salespeople. They don't like them. It's just kind of our human nature. They don't want to be sold anything. They want to buy. I'm the same way, man. I go into a store, and I could go into Nordstrom and be looking for a bunch of different clothes, and someone comes up to me. It's just my human nature to want to say, no, I'm okay. I kind of want to look around. I want my space. I don't want someone to hype or sell something. I want to see what's there and get the lay of the land. And if you say to them, hey, look, I don't think we're going to switch anything out. That may be the worst thing for you. Let's find out what we're dealing with first, then do the research, and then if there are recommendations to make, we'll do those down the line and we'll educate each other about what the options are. They will respect you so much for using that language. And if you've been on this call every week, you can tell that the words that are coming out of my mouth, they're the same, pretty much paraphrased every time, because I use the similar language. Because, again, I'm not trying to sell them anything. Anyone else who would listen to this training may say, yeah, he is. He's teaching them all these sales techniques. Well, I'm actually just teaching you about human nature and that people don't want to be sold. And I want to trust that my client is smart and that they will make the right decision if I can educate them myself and then educate them properly. Okay? Other questions that you had in your email were maybe you should exhaust other tax-deferred or tax-advantaged savings before going with a universal life policy. Well, my answer is it depends. Okay? If they have an insurable need, okay, so they need that death benefit, and they have discretionary income, then a universal life policy probably is a great thing for them. And so again, it depends on what I see on that information gathering tool. So there's no hard and fast rule to tell to anyone.
Okay, so I know this person rather well, and I know that he currently, just has a small job. He used all his savings. He actually sold his retirement off to start a business, and the business went under. So he's got this policy that he keeps paying on. He's not paying a lot. He's paying probably a little bit over $100 a month for this policy he has because he bought it 15 years ago. I look at a term policy for him right now, and it costs that much for him at the age that he's at now. So, yes, although I would never talk somebody like this into, a universal life policy because he has no other savings.
What is the?
Even though.
What's the face value of the policy?
Well, I don't know. He doesn't know what his policy even is right now. He's assuming that he has a UL, but
so your first step before even giving any type of quotes or anything, in my opinion, is to find out what you're dealing with first. Because yes, there could be tax consequences, there could be surrender charges, there could be a lot of things that could expose your license to liability, and you want to do the right thing, and so you want to know what you're dealing with that person. You have a pretty good relationship with them.
Yeah.
Okay, so you'll be able to take you could even get on, once you have the policy, you can even get on the phone with the company and ask the questions that need to be asked. Like, number one, I'd want to know, once you know what the face value is, does it meet his insurable needs? Because even if you cancel or keep alive the UL policy, he may need additional term coverage to meet his insurable needs. That's the first question that I would always ask. Second is, how is he funding? If it is a UL policy, how is he funding it? Meaning, if there's $100,000 in face, what's the maximum per year that he can put in, and what's the minimum per year? As I said last time, many agents will buy a higher face value UL policy, and they'll minimum fund it, which means very little is going into the cash value. All the commissions are being paid out of the premium dollars that are being paid monthly, and the cost of insurance is being covered. So basically, they're using it as a term life insurance policy, but they're getting less coverage than they could buy, and they, they're not getting the tax advantage relief that that they would if they were max funding it or close to max funding the policy. So I would ask those questions. The other question, too, I would ask is, how insurable is he? Because if he's not insurable, then this might be a policy that you would, if he's on a tight budget, it might be something that we would convert. So again, we can go through a lot of hypotheticals, but until we know exactly what it is, then it's hard to answer those questions. But I wanted to be clear, if I wasn't last week, that there are consequences for terminating a universal life policy. Any cash value policy that you terminate, any policy that you terminate without being approved, and you know for sure that it's the right decision to terminate and or do a 1031 exchange with the cash in that policy, unless you know exactly what you're doing there, don't ever advise or maybe even stop someone. You want to stop someone from terminating that policy. Okay?
Okay. Yeah. So let me ask you, you just said something about insurability. So this is kind of a general question, but along those lines, obviously a lot of people that you talk to are people that are uninsurable because they're able to want life insurance. So if somebody, let's say, had a pre-existing condition and they've been, considered better for a year or more, are they then insurable, or are there companies out there that will insure the higher risk?
The answer is it depends. As always, I'm the lawyer, so that's my answer. But there are companies that will insure people that are higher risk, number one. Number two, a year is not enough for it to come off of their health record, usually 7 years. Sometimes they'll even go back and ask for the 10-year. And then on some conditions, they'll say, have you ever in your lifetime experienced this? And so it depends on the company. Again, that's why our Brokers Alliance is so awesome, because they know all the carriers and they know which ones. If you do a preliminary health questionnaire, this was something that came up, I think, 2 phone calls ago. I can't remember who it was. It was Russell, I think. I said you can do what's called a trial application. But even before you do that, you could take a general health questionnaire and say questions like, and I like to do this on the first appointment, even though I'm not taking an application. If I see an insurable need, I have a good relationship with them, I may say, how are you doing with your health? You may know them well enough to ask all those questions. Have you been in the hospital in the last 7 years? Are you on any prescribed medication? Those 3 questions will really get to the bottom and give you enough that when you're doing your research, that with your eyeball test, if they're 5'3" and weigh 250 pounds and they smoke, there's a problem. And so you jot down these notes, and then when you're doing your research, you can call our brokerage help desk and say, we've got someone who's got high blood pressure medicine, they're overweight, and they've never been in the hospital in the last 7 years, but they're treating for this high blood pressure. Are there carriers that could possibly insure this person? Now, you need to prepare them when you see health issues on the first appointment, or if they're heavier or a smoker. You need to be able to say to them, look, I'm going to do the research here, but you obviously know that you have to pass a physical. It could be a physical or just a health questionnaire in order to get insurance. So, I'm not promising anything. And then when you make a presentation, a lot of insurance agents, to get the sale done, on the third appointment when you're making a presentation, a lot of times you'll quote a higher rate class than really what you should. And the reason we do that is because it's kind of the car dealer mentality. Oh, we get them in the door with a lower price and then we can raise it later. Well, I don't know about you, but I'd rather be undersold and over deliver, undersell and over deliver than oversell and under deliver. People are only going to remember the lowest number that you tell them. And it's a loss leader. They do it all the time on the radio. You hear the ads. A 40-year-old male could get a $500,000 insurance for $37.50 a month. And so they get a lot of people to call in, but the reality is most people aren't going to qualify for that rate. And so whatever I think after doing my research with the help desk, maybe even calling the insurance company after we've narrowed it down to a couple, whatever rate class I think they may be at, usually I'll quote a lower and say, hey, look, I think we might be able to get you a better rate than this, but it's going to probably be right in this range. So you'll quote them a table J or K as opposed to an A table, select A rating, whatever, ultimate select, whatever the best rating category is. And then if you get them a better rate after they're approved, then fantastic, you're the hero of the day. Okay?
Great.
Any other comments or questions on this? I wanted to cover some annuity, but if we need to change annuity for next week, and we can answer more follow-up questions about life insurance today if you want.
Go ahead.
Well, I was just going to say another option for people, is the group term. They may be self-employed or something and not be able to get it, but there are jobs where even part-time, I know people that work a job on the weekends just to get the benefits, because their health care is so expensive and they're not insurable otherwise, and they also want to be able to get a group life insurance policy. And a lot of times to have an increased premium within a group policy, a group plan, you have to pay for yourself, but at least you're insurable. And if you've got a life-threatening illness, and there's no other option for your burial and for other things like that, that may be an option for people. I mean, it's hard to talk about with people, but that may be a way to get them some insurance. Was that Julie? Did you have another question?
Yeah, I do. I feel like I'm taking the whole meeting up, but
well, I think this is good for people to hear.
Okay, so I have another appointment set up for next Wednesday with this person that I sold Medicare to yesterday, and she had some questions, and I kind of acted like, oh yeah, I'll get that all figured out for you. But basically, her question was that she had talked to somebody in the past. She's the one who was not insurable because of some kind of pre-existing condition a while back. So who knows if we'll be able to do anything. But basically, she was asking about, she couldn't figure out the word for it. But let's say she was trying to get final expense paid once, she died, didn't want her kids to have to deal with having to pay the funeral home straight up right afterwards and wait for the benefit to be paid out. There's a word for that where you take care of all this stuff ahead of time, where certain creditors or vendors could be paid off before the benefit is paid out. Is that true?
Well, let me first say this. There is last expense insurance that you can buy. Okay. Number two, savings accounts work really good for that as well, depending on their life expectancy. And you compare that to the premiums on a last expense policy. If they outlive the time, it may be more, it may be better for them to just put that money in a money market savings account and not touch it and know it's for their last expenses. And they put that in their will to make sure, one of their beneficiaries doesn't come and grab it and do something else. Third is make sure this person has their estate plan, their will, and their trust. If they own real estate, in California or Nevada, they have to go through probate if they have real estate, even if they're upside down. So they want to put that in a simple will and pour over will in a living trust, and that should be done. Fourth, if they're debts that she incurs in her lifetime and they're solely in her name, the estate, meaning the assets that exist on the day that she dies that are in her name, the estate, those creditors can make a claim against the estate in the probate if there's enough assets, there'll be a probate open. If there's a trust, then they won't have a trust, but they can, a probate, but they can make a claim for those assets. But life insurance, if you make a person the beneficiary, so if this woman makes her daughter the beneficiary, that's payable tax-free to her daughter, for example. And it is not subject to any creditor claims. Okay?
Oh.
So life insurance, if I die tomorrow, my life insurance policy is going to pay out to my wife. It is not a part of the estate. Life insurance has been designed, and the insurance lobby has spent billions of dollars over 100 years to make sure that their product can escape the jaws of creditor. Now, there's always exceptions. If there's fraud involved, and there's some other exceptions, and state law may apply. So you have to look at that. But the general rule is that the life insurance proceeds pay out to the beneficiary, and they are not a part of the decedent's estate. Therefore, they're not subject to creditor claims. That's why when you have someone that's wealthy, they may not need insurance for the purpose of last expenses or to replace income or anything like that. But we use insurance for for estate planning, tax planning, sometimes creditor planning, and there's some other, there's other reasons that we use life insurance. So just because someone has money doesn't mean they don't have an insurable need. That's why we went through a list of several 2 weeks ago.
Okay, so then how do those creditors get paid once that happens?
They get paid out of any assets that exist in the decedent's estate on the date of her death. And they have to go through a process, usually through probate. If not, then they would ask the trustee of the trust, and they would have to go through that. Think about it. If I've got a debt on a car, okay, that's a secured asset, okay? It's an asset that's secured by the note that I signed with the credit union. So when I pass away, if that loan is solely in my name, they have the assets of my estate, and they're in a secured position against that car. So they can repossess that car, even though I'm dead. They can repossess that car. They can sell it, and then they can pay off their note. If there's a deficiency, then they can go to the probate or to the trustee of my trust and say what assets are available to pay this out. And kind of like a bankruptcy, if there's not enough assets to pay all the creditors, then they take on a pro rata share, and there's priority. State law will determine the priority of those creditors and how they receive that money. But life insurance proceeds, do you understand? You must understand this fundamental thing. Life insurance proceeds, if they're payable to a person, they are not part of the decedent's estate. Do you understand why?
For the reason you're explaining.
They're paid upon death instantaneously. They're vested in the beneficiary's name. By operation of law and by their contract, they're not a part of the estate. If it did pay into the estate first and then had to be distributed to the beneficiaries, and I see this from time to time, I'll review a policy like this guy's UL policy. That's why you want to get copies of it. You want to find out who the current beneficiaries are and make sure everything's done correctly, how the ownership is listed in the policy, because all of those things will affect what happens upon their death. And so I see people, they'll put their trust as the beneficiary. Well, if you want to have a taxable event, probably, and you want to possibly make it subject to creditors, then you go ahead and do that. Now, if a tax advisor and an attorney has advised you to do that, and they've explained clearly the reasons why, then there may be reasons why that you make someone other a person the beneficiary of a life insurance policy. But most of the time, to avoid taxation and also to avoid creditors, we make that person the beneficiary. Now, the kid, once they receive that $100,000 or whatever, do they have to use it for the expenses of the estate to bury the mother in this example?
Say that again?
Do they have to use the life insurance proceeds if we made the daughter the beneficiary, the mom passes away, does the daughter have to use the proceeds of the life insurance policy to pay the last expenses that are really an obligation of the estate? Yeah, they don't have to. Could they use them? Yes, they could. But they don't have to. The last expenses are the obligation of the estate, of the decedent's estate. Now, other people usually pay for it, and they sign a. So Steve's sending me emails. All right, cool. So are you saying I'm not saying it right, Steve, or am I saying it right?
You got it.
I think you just found a website that's confirming what I said. I'm not reading off any website. This is just from my experience, and of course I could make mistakes that I deal in this area quite often. So, all right. Any other life insurance questions? Do we want to get into some annuities today, or keep going with life insurance? I want you to understand it so that not that we used to joke about this, but not that you bomb it all over your client. You've got to hold back your information, and on the first appointment, ask a lot of questions. Write down a lot of their questions and a lot of the things. Gather all the information that you can. If you don't have it once you come back to me or Steve or whoever, then you need to call them up and get more of those questions answered so that you can be totally thorough on your research and analysis before you go back and make a recommendation, if anything. All right. We all said when we first started this call that we wanted to be really good at this. And in my experience, most people that sell life insurance, they're not really good. I mean, the people yesterday that I talked with, I'm sure there's great ones out there, and there are good ones. But it just over and over again, I meet up with people and I review their policies, and I'm like, wow, what in the world? Why was this set up this way? I can't think of any other reason other than commission that this was done. No follow-up. I mean, my clients yesterday, how sad for them. They each got a $10,000 policy. Both of them are lapsed. I calculated how much they paid in premiums over the last 20 years for this. They thought it was a permanent paid-up life insurance policy, which it was not. They've each paid over $14,000 into these policies for a $10,000 benefit. And guess what? The client will determine on their own. You don't have to tell them. I just asked a lot of questions, and I said, how much were your premiums? And I said, how long have you been paying in? And I could have told them what the number was, but I watched their faces, and they were doing the math in their head, and they said, wow, we could have just set up a savings policy, and we would have, over $14,000 each for our last expenses, and we didn't even need this life insurance policy the way it was set up. And I didn't have to tell them that. I didn't have to be the bearer of bad news. They discovered it on their own through the questions and through me taking the time to go through step by step. It only took us about 35 minutes to do the whole appointment to analyze and explain what their life insurance policies were about. They brought them all in. I said, I'm not going to meet with you unless you bring your policies in. If you don't have them, go get a copy. I said, I'm not going to meet with you unless you bring those. I need the statements. If you have a dispute with your company and you've fought with them, I need your notes and your emails and your letters. I want to get a snapshot of all your dealings with this company so that I can give you the proper counsel. So anyway, it takes a little time to be better than average, but don't we want to all be better than average at what we're doing? And what do we do before we say goodbye every single time to a client, either on the phone or in the meeting? I'm going to keep asking this question every week until everyone screams it out in unison.
Referrals.
Ask for referrals. And the best way to do that is, who do you know? Instead of, hey, do you have anyone that you could refer to me? Nope. Who do you know that just got married? Who do you know that just had a baby? Who do you know that just changed their job? Who do you know that? And there's 20 of them that you could list out and you could ask them. All right? Those are just people that you want to meet with, and if they know them, then they're comfortable in giving them a referral to you, and that's how your business is going to grow. All right. We only have about 20 minutes. Let's go into annuities if we could. I want to understand. I don't want this to be just a straight up lecture where you guys are bored to tears, but I also want to make sure you understand what an annuity is. Most people do not understand what they are, and they call all the insurance companies, like the life insurance companies. Well, life insurance companies are annuity companies, but they call their products different things, and so it can get confusing. But I think annuities boil down to two different categories, okay? You have fixed and variable annuities. Now, within those annuities, they have all different types of features and things that you can do to activate it, and we're going to talk about them. But I'm talking about how the annuity accumulates when you haven't annuitized the contract. Now, does everyone know what I mean when I say annuitize the contract? Because you don't have to do this. An annuity never has to be annuitized. It can be, and there are times when it should be, and it is an option of all annuities to be able to annuitize it at some point. But does everyone know what I mean when I say you have an annuity that's not been annuitized and you have an annuity that has been annuitized, and do you know the difference between those two? Remember, this is where we practice and we question and we try to understand, not in front of the client. So if you don't know what I mean by annuitize, please let me know and let's explain it. If not, we don't have to explain it.
I don't know. I don't know.
Who is that?
Julie.
Okay, Julie. Okay. So if you have an annuity, it's a contract with a life insurance company. If it's a fixed annuity, like fixed life insurance or whole life, the funds that you use to fund the annuity, it can be done with a lump sum. Some contracts allow you to put in payments over time. Some of them don't. Depends on what type of contract you have. But for a fixed annuity, most often, those funds that you use to put in to fund your annuity are intermingled with the company's funds. On the statement, it'll show how much money you have in your account contractually with that company. So when you see the word guarantee with an annuity company, it's guaranteed by the insurance company and their stability. And they're usually not referring to a state guarantee fund, which is also in place in case an insurance company goes out of business. There's no guarantee that if an insurance company goes out of business, everyone's going to receive all of the premiums or the amounts that they put into that policy. Let's say you're dealing with, for example, a $20,000 annuity, and you funded it with $20,000, and you've signed a contract that they're going to, if it's fixed, they could tie it to an index, or they could change it every year on how much. But let's just say it's going to earn 5% a year for the next 10 years. That money inside of that policy, have you paid the $20,000 before or after tax dollars?
After.
Most of the time, you funded it with after-tax dollars. Can you put an annuity into a qualified plan so that you're funding it with pre-tax dollars? Barbara knows the answer. She might not be able to answer, though. She might be at a place where she can't talk. Does anyone know the answer? Jim Breedlove hung up. I was bored. No, maybe, yeah, he's off. The answer is yes. okay? There are qualified plans. For example, all the teachers and firemen and police, they might have what's called a tax sheltered annuity or a 403B plan where they're funding that. It's an annuity, and they're funding it with their pre-tax dollars, and the money grows tax deferred inside of an annuity. Matter of fact, if you know any teachers or any other public servants, they probably have a 403B, which is a TSA or tax sheltered annuity, and they may even be required to fund their retirement plan inside of that annuity. And you can get appointed with those companies sometimes while they're working for the school district, but definitely if they've changed jobs and they've got an old TSA, you might be able to roll that over and get paid the commission to now put that with the new company, again, if it makes sense, and be the agent of record and get paid a commission on that. Okay, so back to this annuity. So let's say this thing grows and it grows tax deferred, and it was paid with after-tax dollars. And over the next 15 years, it builds in value, and now it's worth $40,000. All annuities like this, you should go to the insurance company and you could ask them, I want to annuitize this contract, or I'm thinking about it. How much will this pay me if I annuitize the contract? And they will, just like the California lottery, you've heard about that, or Powerball or whatever, you can take a lump sum or you can take payments over the next 30 years. You've heard of that, right? All they're doing is taking that cash, that $100 million, and they're buying an annuity with it. And if you die before the term ends, then you don't get as much money. If you live past the 30-year term, or it may just be up to 30 years, then you get more than the lump sum. That's how annuitizing an annuity contract works. So there's an option to turn the contract into, for example, a monthly payment plan where they would pay on that $40,000. These aren't factual numbers, but let's say they agree to pay you $100 a month for the rest of your life. And you can do the math. If they live 40 more years, they're going to get more than the $40,000 plus a reasonable rate of return. If they die the next year, they've lost the $1,200 out. So there's mathematics that needs to be done, and again, their actuaries are usually right on. They know exactly. But people want a fixed income. They don't think that the contract's really going to grow. It's not producing enough income for them, and so there's an option to annuitize a contract. Once that contract is annuitized, there's really not a lot you can do. You can't roll it over. Usually you can't do anything but receive those payments. Now, the payout on those can vary. People's pension plans have been done this way, where you can take a 10-year set payout. Now, do you think a 10-year set payout on an annuitized contract would be higher or lower than a lifetime payout for a person who's 60 years old? Anyone with me?
Lifetime.
Do you think a 10-year fixed payout would be higher or lower than a lifetime payout for someone 60?
Lifetime.
Which one would be higher, the lifetime payouts per month or the 10-year payments? Payments just for 10 years and then all the payments cease.
Well, the monthly payment would be higher on the 10-year, but you'd get less overall.
Okay, so why would it be higher?
Because you're putting it in a shorter amount of time.
It's probably a shorter amount of time, right, for a 60-year-old person? If the life expectancy average is 74, is that what you're basing it on?
No, I'm just basing it. Yeah, I'm basing it on how long he might live.
That's right. So again, these are things that you want to look at. I have never purposely annuitized a contract except for someone who is in dire financial need of monthly income and not the lump sum, because you forego the right to use the $40,000. So depending on what interest rates are, that $40,000, if they're financially in a hard time, what are they going to do if they need a car repair and they're only getting $200 a month out of their annuity? They could put it on a credit card and then they use the $200 to pay it off, or they could go into the $40,000 nest egg annuity and either borrow that money or surrender that money and use it to pay their bill. So again, the first appointment is so important to understand exactly what their needs are, where they're at, what their goals are, and then getting the copy of the contract so you know exactly what the crediting policy is inside the annuity contract, what the historical performance has been with that contract, surrender charges, all of those type of things. Now, you can put qualified money into an annuity. If it makes sense to do it, then you can do that. You can roll old 401ks from prior employers. You can roll IRAs, self-directed IRAs, Roth IRAs. You can roll those without having a taxable event. It's called an institution-to-institution transfer. And again, as long as it's suitable and you do the paperwork correctly and you know all the pros and cons, and so does the client, you can transfer those type of retirement vehicles into an annuity. So it's another avenue for you to use your life insurance license and your annuity license to roll that money. And you know, the commissions are usually pretty good. You got to make sure, again, everything's suitable. But these annuity contracts usually pay more than the fixed accounts, for example, in a CD or a money market account. So many times it might make sense to at least look at that as an option. Okay, variable annuity, like a variable universal life policy, the money that's put in to the cash value of the policy of the annuity policy is held in a separate account again. Again, if you don't have a variable license, then it's really hard for you to give advice about that policy, other than you can tell them what it is, and you can look up the costs and expenses and fees associated with them having that in a sub-account. It's basically like a mutual fund. It's similar to a mutual fund inside of an annuity shell. Okay? Why would you, if someone is suitable and they want a mutual fund, why would you ever put a mutual fund type of account, a securities or a mutual fund type of account inside an annuity? What would be the primary reason of doing that?
Just the risk reward.
Well, what if you have the exact same risk and the exact same reward? Matter of fact, it's the same fund manager in ABC mutual fund as it is in ABC sub-account inside the annuity. What do you think? It'd be the same rationale. Let's say someone has a savings account and they're in a CD and they're earning 2%. And you tell them, look, we might want to look at an annuity to put this money in there. What would be, I can think of at least 3 benefits of, instead of them putting that into that savings account, assuming it's a long-term account, they don't need to touch the money for 20 or 25 years. Any ideas? How does the money grow inside an annuity?
Tax deferred.
Gross tax deferred. So if all things being equal, which one in 25 years is going to have more money in it?
The annuity.
Why?
Because it's growing tax deferred.
Yeah, so it's instead of one step forward, a half a step back, right? With that savings account, don't they have to declare their interest as income and pay taxes on it every year? Well, it depends on their tax situation, but most people, yes, right? Don't you guys get a statement on your savings account? Now, you ignore this fact because it's so low, but don't you get a statement every year in January? You got a statement that said you earned $42.53 in your checking account last year in interest. Remember that statement you get every year? Yes, someone? You get it. It's income to you. You're supposed to report it. And so if they're earning 5% in the CD, they got $100,000 in there. There's $5,000 in income every year they have to report on their taxes. If that same $100,000 were in an annuity earning 5%, they don't have to pay tax on it. And so after 1 year, they're earning 5% on $105,000 in the annuity. And how much are they earning on in the CD? Let's say they're paying 30% income tax. You guys wish that was the case in California, right?
Now unmuted.
3 times 5 is 15. So out of the $5,000, $1,500 has to come off, right? So the CD now is going to earn 5% the second year on $103,500. That's the magic of compound interest. And there are calculators that you can use that are online. You can find them anywhere. Bankrate.com, I think, might still have them. But all the insurance companies have these tax-deferred calculators. And and our Brokers Alliance does too. And you can use these to show people, look, this same $100,000 over the next 20 years, if it's tax-deferred, look how much more money it is than if you have to pay the tax on it. So that's one reason why you might consider the annuity. The other reason, there's always going to be a cost of insurance inside of the annuity. And so the securities brokers and the mutual fund people and the bank people will say, well, yeah, but you better be careful because there are insurance costs inside of the annuity that may be equal to or even greater than the taxes this person would pay. And they're absolutely right. So you and I have to do our homework. We have to understand it. Don't get overwhelmed by this. Most of you are rookies on the phone. But you can learn it. And it pays you well to learn it because people are in these vehicles. Like I said, there's millions, tens of millions of people in the Western United States in a TSA through the school district and other places, and they have no idea that they're even in an annuity. All they do is when they look at their accounts over the water cooler, their friend says, well, I earned 20% last year and I had this small cap fund. Oh, I'm going to try that this year. Well, they may have missed their window trying to chase those returns. Most of the time, they have no idea what's happening, even in this information age, and they just do it and just hope for the best. A lot of times, the annuity also could pay a higher return than a CD. They usually do pay a point or two higher. So you might be able to, by locking in the same term as a CD, be able to get a little higher return and also have it be tax deferred. But remember, when can you take out tax deferred money? How old? Someone say, do they know? If you start an IRA today for my 8-year-old son, it's my 8-year-old's birthday today, when can he touch that money without a penalty?
59 and a half or something?
Yep, 59 and a half. So again, you got to keep that in mind when you're setting up these tax deferred accounts. But you can set up an IRA inside of an annuity. You can roll that qualified money over, and it's a way for you to give them some security. The other benefit, which I mentioned earlier, why someone might want the annuity is they always have the option to annuitize the contract with an annuity, which you don't have with the CD. So If someone's in a position where, in the later part of their life or even earlier, they need to have some set payments, then that's what they do. As an attorney, I have a client that got in a car accident and she got $1 million for her, injuries. The court wanted her to put that into a fixed annuity that would pay her income for life because of her disability, and that's what the court approved. So, but they put some of that, and she gets monthly payments. And when she turns 21, that could be a good thing, right? What would most 21-year-olds do with a $300,000 cash in a bank account now that they are in charge of that account?
Spend it.
They'd spend it. Buy a car, buy a lot of cool stuff, go on trips. And so the judge wanted to make sure that there was something in place that for the rest of her life she would still have at least some monthly income, and that she wouldn't spend the money. Well, guys, we're just about out of time. Oh, I see Steve's note, 59.5. Good job, Steve. I hope this has been valuable to you guys. I appreciate the time working together with you, and I'd love to hear your success stories. Please pass them on. As I know I've talked to our broker, and there's many of you that have become appointed with us or are looking into becoming appointed with us, and we even have business that's pending and already been written since we started these calls, just from this fresh new group. So congratulations on that, and keep working your business, become a professional, read something every day. I would recommend that you spend a half an hour to an hour every single day reading information about some of the things we've talked about. If you've taken notes, you have questions, you'd like to understand it better. It's boring to talk about taxes, but these are tax advantage vehicles, and the more you understand how they work. I mean, we didn't even talk about how they're taxed once you take them out, but knowing those type of things, again, giving the disclosure to your client that you're not a tax professional or a lawyer, but being able to discuss it and knowing the questions that they can ask their accountant if it's a big issue to them. Those are the type of things that will set you apart from your competition.